As the final week of 2025 unfolds, a unique atmosphere descends upon Wall Street. The city that never sleeps seems to pause, and the financial heart of the nation beats a little slower. A quiet calm has settled over the U.S. stock markets, with trading floors echoing a rare sense of stillness. The usual energy and urgency have faded, replaced by a gentle lull that feels almost surreal. The usual roar of the trading floor is now a whisper, reflected in the stillness of stock market futures. Screens that once flashed with constant updates now display only minor fluctuations. Major indices like the S&P 500, Nasdaq 100, and Dow Jones are barely moving, signaling investor hesitation. The charts remain flat, as if the market itself is holding its breath. This pause follows a recent retreat, with 2 straight sessions of lower closes, mainly due to profit-taking in heavyweight tech stocks. Investors are taking a step back, reassessing their positions after a period of rapid gains. After a strong year, many investors are locking in gains, casting a cautious mood over the market's final days. Portfolios are being reviewed, and strategies are quietly adjusted for the year ahead. The holiday season naturally slows trading, with many professionals away and volumes thin. Offices are emptier, and the usual buzz of activity is replaced by a sense of waiting. But there's more at play. Investors are also waiting for key economic events, especially the upcoming Federal Reserve meeting minutes. The anticipation of policy signals adds another layer of suspense. This quiet is a moment of transition, a calm before new information could shake things up. The market is poised, ready to react to the slightest shift in sentiment or news. Investors are reflecting on the year's gains while bracing for what's next. There's a sense of gratitude for the successes, but also a readiness for the challenges ahead. The muted futures show a market in holding pattern, waiting for clearer signals. Every trader and analyst is alert, watching for the first sign of movement. This is a crucial time for observation, as subtle shifts now could set the stage for next year's trends. The smallest data point or policy hint could spark the next big move. The stillness is not emptiness, it's anticipation and strategic positioning. In these quiet moments, the seeds of the market's next chapter are quietly being sown. The final week of the year is known for exceptionally low trading activity, a holiday lull that sweeps across global markets. This period is almost legendary among traders for its quiet, as the usual buzz of the trading floor fades into near silence. Many top portfolio managers and traders are away, taking time off to recharge with family and friends, leading to a sharp drop in market participation. The absence of these key players means fewer big trades and less liquidity in the market. With fewer buyers and sellers, trading volumes plummet and price movements are subdued. The usual flurry of activity is replaced by a calm, almost eerie stillness on the screens. Futures contracts, key indicators of sentiment, are barely budging. S&P 500 futures are moving by just 0.1%. Even the most closely watched indices seem to be on pause, reflecting the lack of conviction in the market. The shortened week, with markets closed for New Year's, gives investors little incentive to make big moves. With holidays on the calendar, most are content to wait for a fresh start. Most institutional players have already wrapped up their year, leaving the field to smaller traders and algorithms. Automated systems quietly keep things ticking over, but the human element is largely missing. This lack of participation can make small moves seem bigger, but often just means little is happening. The market's apparent volatility is more illusion than reality. Savvy investors know to sit out, waiting for the real action to return in January. They understand that patience now can pay off when the market wakes up. Until then, the market is in semi-hibernation, quietly waiting for the calendar to turn. The city's financial heart beats slower, anticipating the surge of activity to come. The signals right now are more about absence than direction. A reminder that sometimes the most important move is simply to wait. One of the biggest stories lately, grabbing the attention of investors and analysts alike, is the retreat in technology stocks, which have seen a sharp reversal after months of impressive gains. Tech led Wall Street's growth all year, creating huge paper profits for investors and fueling optimism across the market. Now, as the year ends, many are selling these winners to lock in gains, a classic year-end profit-taking move that's as much about strategy as it is about timing. This isn't a loss of faith in tech, but a prudent strategy to turn on-paper gains into cash before any downturn and to manage tax liabilities as the calendar flips. The result? A wave of selling pressure, especially in the Nasdaq, which has underperformed recently and become a focal point for this activity. Even the Dow has felt the ripple, as tech's influence is broad and touches nearly every corner of the market. This synchronized selling has broken December's upward momentum, halting what many hoped would be a strong finish to the year. But it's not panic. It's strategic and orderly, a normal part of healthy markets that often sets the stage for future growth. Investors are rebalancing after exceptional returns, not fleeing bad news, and many are simply adjusting their portfolios for the new year. This creates new opportunities for buyers who still believe in tech's long-term story, as lower prices can be an attractive entry point. The key question: how long will this profit-taking last? And when will new buyers step in to drive the next chapter of growth? Profit-taking is simple in theory: sell high to realize gains, but the psychology is complex. Investors sell to manage risk, knowing no stock rises forever. Year-end is a natural time for review and rebalancing, especially if one sector, like tech, has grown too large in portfolios. Tax strategies also play a role, as investors may want to offset gains or defer taxes. Fund managers, judged on annual performance, are motivated to lock in strong returns before December 31st. When many take profits at once, it creates selling pressure and can halt rallies. It's a tug of war between fear of missing out and fear of losing gains. This year, the urge to protect 2025's profits has outweighed the desire for more. The result: a powerful, collective shift that's as much about emotion as strategy. Market moves are driven by both data and human psychology. Wall Street's focus this week is on the Federal Reserve's meeting minutes. These minutes, released Tuesday, offer a detailed look at the Fed's internal debates and reasoning behind interest rate decisions. Investors are searching for clues about the future path of rates, hoping for signs of cuts in 2026. The minutes will be scrutinized for any language confirming or challenging this belief. Insights into inflation, labor market health, and policymakers' views will help shape market expectations. A hawkish tone could disappoint, while dovish hints could fuel gains. In a quiet week, these minutes are the main event, likely to set the tone for the start of the new year. For investors, this document is a critical piece of the puzzle. Investors comb through Fed minutes like financial detectives, searching for hints about future policy. The main hope: confirmation that rate hikes are over and cuts are coming in 2026. Any sign that inflation is under control would be a big positive. They'll also look for the Fed's take on the labor market, ideally a soft landing with no major job losses. Investors want to know what data the Fed is watching and what would trigger a rate cut. Clarity here reduces uncertainty, which markets love. The best-case scenario: a united, confident Fed, ready to pivot to easier policy. Any sign of division or confusion could rattle markets. The Santa Claus rally is Wall Street lore, a tendency for stocks to rise in the last days of December and early January. It's fueled by holiday optimism, year-end bonuses, and low trading volumes. This rally is seen as a barometer for the year ahead. If it fails, some see it as a bearish omen. This year, profit-taking in tech has cast doubt on the rally's arrival. The market's recent decline and quiet futures add uncertainty to this usually cheerful period. The fate of the rally may hinge on the Fed minutes and the market's mood as the year closes. A dovish Fed could spark a late surge. A hawkish surprise could dampen spirits. The tension between tradition and current market forces makes these final days especially interesting. Despite recent softness, 2025 has been a strong year for U.S. stocks. Major indices are set for solid gains, far exceeding early expectations. The rally was fueled by hopes of a Fed pivot to easier policy and a resilient economy. Fears of recession faded as growth in the labor market stayed strong, supporting corporate earnings. The Goldilocks scenario, robust growth and the promise of lower rates, drove stocks higher. Looking to 2026, optimism remains. Investors expect positive trends to continue, with lower rates boosting stocks and profits. Advances in tech, especially AI, are expected to support further growth. The current lull is seen as a pause, not the end of the bull market. Investors are recalibrating, not retreating. The dominant narrative, resilient growth, and easier policy still shapes expectations for the new year. The market's quiet surface at year-end hides powerful currents beneath. Thin trading and muted futures suggest stillness, but anticipation and strategy are everywhere. The recent tech profit-taking is a logical end to a year of big gains, a healthy rebalancing, not panic. All eyes are now on the Fed minutes, which could break the calm and set the tone for 2026. Even in a slow week, one event can change everything. The market is never truly asleep. Psychology, strategy, and history are always at play. The year's strong performance is built on resilience and hopes for easier policy. As 2025 closes, the pause feels like a prelude to the next phase. The market is waiting, ready for new opportunities and challenges. Those who pay attention now are best prepared for what comes next.